There's a technical pattern in the silver market that has appeared exactly 7 times in the last 40 years. Not a gut feeling, not a rumor from a trading desk, a specific measurable formation that shows up on the price chart when certain conditions align. And when this pattern has completed in the past, silver has moved an average of 37% higher over the following 6 to 12 months. Not every time, not in the exact same way, but 7 out of 7 times, the directional move has been up. As of Friday, April 17th, 2026, with silver closing at 79.88, that pattern just triggered again for the 8th time. We're triggering from a price level that's already 150% higher than where silver sat just 3 years ago. Either this signal is about to fail for the first time in 4 decades, or we're looking at a continuation move inside the largest silver bull market of the modern era. I'm not going to tell you which one will happen, because I genuinely don't know. Nobody does. What I can do is show you exactly what the signal is, walk through the 7 previous times it appeared, explain the current market structure, and give you the framework to make your own decision. I'm the stat guy, and if you're holding silver, thinking about buying silver, or trying to understand why this market is moving the way it is, the next 26 minutes might be the most important market analysis you watch this month. We don't upload 8 videos a week chasing every $2 move in the silver price. We don't promise you secret information from insider sources, and we absolutely don't tell you that something is guaranteed to happen in the markets, because the only guarantee in markets is that nothing is guaranteed. What we do is this. We study technical patterns, market structure, and historical precedent. We show you the data, we show you our methodology, and we show you both the bull case and the bear case, so you can think clearly instead of emotionally. The pattern I'm about to show you is called a falling wedge breakout with volume confirmation. A falling wedge forms when an asset's price makes lower highs and lower lows, but the rate at which it makes lower lows is faster than the rate at which it makes lower highs. Visually, if you draw a line connecting the peaks and another line connecting the valleys, those 2 lines converge like a wedge that's tilting downward. The compression represents something real happening in the market. Sellers are getting exhausted. Each time the price drops, it drops less than the time before. Meanwhile, buyers are becoming more aggressive. Each time the price rallies, it takes less decline to find support. The market is coiling. Think of it like a spring being compressed. The tighter it gets, the more energy is stored. And when it releases, that energy converts into movement. Silver is a small market. The entire above-ground investable silver supply is estimated at around $75 billion in value. For context, that's smaller than the market cap of Netflix. When institutional money, industrial buyers, or sovereign accumulation enters this market in size, the price doesn't move gradually, it gaps. The specific signal we're watching for has 3 components: the wedge formation itself, the breakout, and volume confirmation. As of April 17th, 2026, silver has now satisfied all 3 conditions. The wedge formed between March 28th and April 16th. The breakout occurred on April 17th when silver closed at 79.88, clearing the 79.20 resistance line. The volume on that breakout session was 43% above the 20-day moving average. Clear confirmation that this wasn't a random spike. This pattern is not a guarantee. In trending markets, falling wedges have approximately a 68% success rate of producing a continuation move. That's good. That's better than a coin flip. But it also means that roughly 1 in 3 times the pattern fails and price reverses back inside the wedge or breaks down entirely. Our job isn't to pretend that 68% is 100%. Our job is to look at the 7 previous times this exact setup appeared, see what happened, and compare them to today. Occurrence number 1, September 1986. Breakout price, 587. 6 months later, 724 by 123.3%. 12 months later, $8.03, 136.8%. Context: post-Hunt Brothers. Collapse recovery, Fed easing cycle, industrial demand recovering. Occurrence number 2, November 1993. Breakout price, 412. 6 months later, 535, 169.9%. 12 months later, 542, 131.6%. Context: technology boom increasing industrial silver demand, low inflation environment. Occurrence number 3, October 2001. Breakout price, 428. 6 months later, 489, 2%. 12 months later, 463, or 8.2%. Context: dot-com crash aftermath, 9/11 uncertainty, beginning of Fed rate cuts. Occurrence number 4, August 2005. Breakout price, $6.94. 6 months later, $10.15, 146.3%. 12 months later, $12.33, 127.7%. Context: Chinese industrial expansion. ETF launches, creating new demand, housing bubble peak. Occurrence number 5, December 2008. Breakout price, 1078. 6 months later, 1467, 136.1%. 12 months later, 1699, 157.6%. Context: global financial crisis, quantitative easing announced, currency debasement fears. Occurrence number 6, July 2016. Breakout price, 1964. 6 months later, 1623, 17.4%. 12 months later, 1685, 14.2%. Context: post-Brexit vote spike, Fed hiking cycle resumed 4 months later, strong dollar. Occurrence number 7, November 2019. Breakout price, 1712. 6 months later, 1578, 7.8%, but COVID crash intervened. 12 months later, 2415, 41.1%. Context: pre-COVID slowdown, repo crisis, Fed balance sheet expansion restarted. Way average outcome across all 7, 128.8% at 6 months, 137.2% at 12 months. Success rate, 6 out of 7 positive at 12 months, 85.7%. What it tells us, the pattern has been more reliable than not. 6 out of 7 times. If you bought the breakout, you were profitable 12 months later. The magnitude of moves has varied wildly, from 8% to 77%. Context matters enormously. The 2005 and 2008 occurrences happened during massive monetary expansion. The one failure, July 2016, is particularly instructive. The breakout occurred, volume confirmed, and then 4 months later, the Federal Reserve resumed a hiking cycle that sent the dollar soaring and crushed precious metals. The pattern fired correctly, but the macro environment overrode the technicals. So the question we have to answer today is this: does the current market environment look more like 2005 and 2008, or more like 2016? Factor number 1, interest rate environment. In 2016, when the pattern failed, the Federal Reserve was in a hiking cycle, rates were rising, the dollar was strengthening, and real yields were moving positive. Today, the Fed has created new money for 8 consecutive weeks through open market operations. The 10-year real yield stands at approximately 0.4%, down from 1.2% 6 months ago. The trajectory is toward negative real rates, not positive. Verdict: environment supports the pattern, more like 2008 than 2016. Factor number 2, dollar strength. When the pattern has failed or underperformed, the US dollar index has been in a strong uptrend. Today, the dollar index sits at 99.2, down from 104.8 at the start of 2026. The trend is clearly down. Multi-decade reserve currency diversification by central banks continues. BRICS payment systems are processing increasing volumes. Verdict: environment supports the pattern. Factor number 3, physical market tightness. The best performing breakouts occurred when physical silver markets showed signs of stress, rising premiums, refinery backlogs, exchange inventory drawdowns. Today, COMEX registered silver inventories have declined 41% since January 2025. Shanghai silver futures are trading at persistent premiums to COMEX, currently $280. Multiple refineries reported Q4 2025 backlogs. The physical market is tighter than at any point in the last decade. Verdict: environment strongly supports the pattern. Factor number 4, industrial demand trajectory. When industrial demand is collapsing, silver struggles even in good monetary environments. When industrial demand is expanding, the combination is explosive. Today, solar panel manufacturing is at record capacity globally. AI data center buildouts are consuming more silver in electrical applications. Industrial silver demand in 2025 was the highest on record at approximately 560 million ounces. Verdict: environment supports the pattern. Summary: 4 out of 4 factors are aligned positively. This doesn't guarantee success, but it does tell us that the current market structure looks far more like the high success environments than the failure case. There's a difference between what markets say and what market participants do. The price tells you what's happening now. Positioning tells you what might happen next. Evidence point number 1, mining company realized prices. In Q4 2025, Hecla Mining reported an average realized silver price of $69.28 during a period when spot averaged $55 per ounce. That's a 26% premium. There are only 2 explanations for that. Either they sold forward at high prices months earlier, or they sold a significant portion to a buyer willing to pay substantially above market for guaranteed physical delivery. Governments and strategic buyers pay premiums when they want volume without moving the spot market. This data point suggests someone was accumulating quietly during what looked like a price consolidation. Evidence point number 2, refinery capacity signals. In August 2025, several U.S. refineries began declining new silver consignment for processing, citing months-long backlogs. Refineries don't turn away business, which they profit from, unless they have higher margin, volume-committed contracts already consuming capacity. Evidence point number 3, legislative positioning. The COMEX Precious Metals Disclosure Act, introduced in Congress in February 2026, would require monthly reporting of beneficial owners behind the largest concentrated short positions. This legislation came after a critical minerals subcommittee member purchased equity in a major silver miner 9 months before that miner reported the unusual realized price premium. I'm not making accusations. I'm observing timing, policy attention, plus equity positioning, plus price anomalies. Someone with information was moving ahead of public awareness. Evidence point number 4, exchange inventory behavior. Since January 2025, COMEX registered silver has declined from 74 million ounces to 44 million ounces, a 41% drawdown. During the same period, open interest has remained elevated, meaning more contracts are outstanding against a smaller pool of deliverable metal. This creates what's called a tight float. And historically, tight floats produce outsized volatility when new buying enters. The breakout we just saw may not be the beginning of the move. It may be the point where the move became visible to technical traders after the strategic accumulation was already largely complete. Scenario 1, continuation rally, probability 45%. Silver breaks above $85 within 3 weeks, holds as support, and trends toward $95, $105 over the next 6 months. What would confirm it? Sustained closes above $85, volume remaining elevated, physical premiums staying wide, real rates crossing negative. Historical parallel, this would mirror the 2005 and 2008 breakouts, slow grind higher with periodic volatility but consistent higher lows. Scenario 2, failed breakout, wedge rejection, probability 30%, silver fails to hold above 79.20, falls back inside the pattern, retests support around $72-$74. What would confirm it? Close below $79 on heavy volume, Fed shifts hawkish, major liquidation event in broader markets. Historical parallel, the 2016 failure, pattern triggered, then macro environment shifted and overrode technicals. Scenario 3, consolidation before next leg, probability 25%, silver chops sideways in a $76-$84 range for 4 to 8 weeks, building a base before resuming higher. Historical parallel, this would be similar to late 2019, pattern fired but needed a macro catalyst to actually launch the move. My personal base case, I'm leaning 60% towards scenario 1 or 3, both ultimately bullish, 30% towards scenario 2, positioned to react to what actually happens, with the $82.50 level. If silver can close above $82.50 for 3 consecutive sessions, that would confirm the breakout has momentum and isn't just a head fake. That level represents the 78.6% Fibonacci retracement of the February decline and has been resistance multiple times. COMEX registered inventory. If we see another 5 to 10 million ounce decline in the next 30 days, that would signal physical tightness is accelerating and support a continuation rally. If inventory stabilizes or increases, it reduces urgency. Real interest rates. If the 10-year tips, yield crosses below 0, that's historically been rocket fuel for precious metals. We're at 0.4% now. Volume behavior. Healthy rallies maintain volume. If we see volume declining as price rises, that's a warning sign the move doesn't have institutional support. Shanghai premium. If the premium of Shanghai silver over COMEX expands beyond $5 that would indicate severe physical market dislocation and potential for a squeeze scenario. A falling wedge breakout pattern just triggered in silver for the 8th time in 40 years. The previous 7 times, this pattern produced an average gain of 37% over the following 12 months, with 6 out of 7 being profitable. The current market environment, negative trending real rates, weakening dollar, tight physical markets, strong industrial demand, looks more like the successful historical cases than the one failure. And we have documented evidence of above-market accumulation, refinery constraints, and inventory drawdowns that suggest institutional positioning was happening before this breakout became visible. But, and this is critical, none of that means this is guaranteed to work. Markets don't care about patterns. They don't care about historical averages. They care about supply, demand, liquidity, and the actions of participants with bigger positions than ours. The pattern and its history, the current market structure, the evidence supporting and contradicting the setup, the 3 scenarios I'm watching, the data points that will tell us which is playing out. If you're holding silver, this pattern suggests the probabilities favor staying in the position, but watch the confirmation levels I mentioned. If you're considering entering, understand that you're buying after a breakout, not before it. That's a trade-off, not a mistake. If you're skeptical, you should be. Skepticism is healthy. Watch the data I outlined and let the market prove or disprove the setup. I'm the stack guy, This channel doesn't upload daily because we don't chase noise. We upload when there's signal. This was signal. 3 scenarios, 5 data points to watch, 1 pattern with 40 years of history. The market will tell us which path it's taking. Our job is to listen.